I was a neophyte trader, and this was the days of the great Japanese bull market. So I was fortunate that I was learning about how to do this when the market was trending in one direction. Well, I got offered the opportunity to go to Japan very young. I was 22, and excuse me, and just jumped at the chance. I mean, I had no idea what I was going to get paid. I didn't know where I was going to live. It just felt like an opportunity to me. So I said yes, and I even then I was young, but I figured, no, if it doesn't work out, I can just come home. When I sit down to write things that make you go home every month, I never have a predisposed idea of. So I won't sit there in January and say, here's what I'm going to write about in February. I always want to sit down and write about whatever it is that I'm interested in when I come to sit down. And just over this last 18 months, there's been more and more signs that Japan is kind of reawakening it. -10, +10 base points makes no difference. But to signal that we are off negative rates and we are normalizing, we're going to move to positive interest rates, suddenly changes the mindset of a lot of people. The cost of capital and the availability of that capital is by far the most important variable. And interest rate differentials matter. And as rates move in one country, they don't automatically follow in another.
Hi, I'm Steve Clapham. Welcome to the Behind the Balance Sheet podcast, where we meet leading investors and commentators and educate ourselves about the world of investing and the world at large. Our mission is to remove some of the mystique around investing and improve our understanding of what makes a successful investment or indeed an unsuccessful one. Our goal is to inform, educate, and entertain. We hope you enjoy this and every episode.
Behind the Balance Sheet and affiliates and podcast guests may own shares or have an economic interest in securities discussed in this podcast, which is aired for your education and entertainment only. Nothing in this podcast should be construed as investment advice or relied upon for investment decisions. Always do your own research.
Grant Williams is a former hedge fund manager, a co-founder of financial streaming channel Real Vision, and today is one of the world's most successful financial influencers. If I were to choose only one investing podcast to listen to, it would be the Grant Williams podcast. That crossed 1 million downloads in its first 5 months. And Grant's paid-only podcast is the only financial podcast in the UK Top 100 chart. His newsletter, Things That Make You Go Hmmm, is one of a handful of publications that I spend my own money on. And as I explain at the end, that has directly made me more money than any other piece of research of the thousands or probably tens of thousands I've read. In this conversation, we discuss Japan at some length. We talk about the potential risks in the US Treasuries market, where a raft of supply could meet a dearth of buyers. And Grant explains why he finds gold so attractive. Of course, we also discuss his podcast and newsletter and Grant's approach to content, which is similar to my own. I like the saying, give a man a fish and you feed him for a day, teach a man to fish and you feed him for a lifetime. Grant is the nicest person in finance, and it's wonderful to hear him answering the questions and being on the other side of the mic for a change. I think you'll come away from this with some actionable ideas, even though we don't mention a single stock. So Grant, welcome to the show. I'm so excited to do this. I've been looking forward to it for some time. And you started at Robert Fleming. And over 35, maybe nearly 40 years later, you become one of the world's, one of the top financial influencers. But you've suffered quite a few setbacks along the way. And I thought younger members of our audience in particular can probably learn quite a lot from your journey. So I wonder, can you please share a bit of that journey with us? We've only got a limited amount of time, so you're very old like me, so it'll take a long time to go through every part. But maybe start by telling us about how you got that job in the front office at Robert Fleming, because that was interesting.
Well, it's good to see you, my friend. Happy New Year to you. Thanks for having me on. I appreciate it. That's an overly generous introduction, but to answer your question, I I kind of bullied my way into the job. To be honest with you, there's no other way to put it. I had a job in the settlements department of the what was the Japanese warrant trading room at Robert Fleming in London, and I desperately wanted a job in the trading room. And so I would get up every morning and come to work and be sitting in the office at 5 o'clock in the morning waiting for John Galvanoni, the head dealer, to come in. Preceded by a big puff of cigar smoke as he came out the lift, because you could smoke in the office in those days. So there he was at 5:45, 6 o'clock in the morning with a cigar going, his hair all over the place. And he would breeze past me, and I'd say, "Morning, John," and he would just totally ignore me. And I did that for months. I forget how many, but probably 6 months of getting up and going in every day. And I had that kind of 5 seconds interaction with him. And then I had to kind of sit around in my chair for 3 hours before anybody else came in that I could talk to. And eventually, I think he realized that I wasn't going away. And a spot came up. Back in the old days, you probably may remember this, our entire team at Fleming's was poached by Bearings, as used to happen in those days. Entire teams were taken by competitors to either set up or beef up operations. And Fleming's lost their entire trading team to Bearings, and so slots opened up. And I think it was just familiarity. It's right. We've got seats that need filling. I recognise that kid who keeps bugging me for a job, so let's throw him in at the deep end. And it was really just persistence and being a pain in the arse that got me a chance.
And what happened next?
Well, I'll tell you what happened. Not long afterwards, it wasn't exactly next. I was an assistant trader on the JGB book originally, back when JGBs had yields and used to trade. That was my introduction. I was just like an assistant trader. And then, more slots opened up, and I got given the Deutschmark Japanese warrant book. And look, Steve, I had very little clue what I was doing. Right? I was a young kid, incredibly naive. I learned from watching people around me. I learned from studying people's reactions and trying to understand why they reacted the way they did. And I really was learning on the fly. I had given up the chance to go to university to take this job because it was right next to the seat that I really wanted. And so I learned everything on the job. And so what happened not long after I was given my own trading book was the '87 crash. I was a neophyte trader, and this was the days of the great Japanese bull market. So I was fortunate that I was learning about how to do this when the market was trending in one direction. I was going up just about every day, and so that kind of took away the uncertainty about, okay, what am I going to come into the next morning? For the most part, obviously, still went up, you still had down days and stuff, but there was a clear trend. And so you could kind of sit back and learn and watch and learn how to trade a market that was moving in a direction without worrying about the direction. That was pretty much set. So the '87 crash came along, October 19th, 1987, and I don't know if you remember. You probably remember in the UK we had a hurricane hit the UK. I think the day before the crash, it hit the UK on the Monday, I think it was, and Wall Street crashed
Friday,
over.
Thursday night was the hurricane.
Oh, it was Thursday night.
Friday
Okay,
morning you came in. Yeah.
okay. So that's right. Thursday night we had the hurricane. Friday morning was a big down day on Wall Street, and then of course the following Monday was the big crash. And so those 2 days, but particularly waking up on the Monday morning, or the Tuesday morning, I guess it was, in the UK of the '87 crash, I was a deer in headlights, make no bones about it. I had no clue what had gone on, as nobody did really, but I just was so inexperienced. I went into the office terrified, frankly. I didn't know what was going to happen. I didn't know, I knew I was going to lose more money than I'd ever lost in the job. I didn't know what kind of number it was going to be, but I knew it was going to be horrific. Because obviously back then you were just long because the market was going up every day. So you didn't need to have shorts really, apart from a few scattered ones here and there. And so, again, I was very fortunate. I had a lot of guys around me who had been doing it long enough that they had steadier nerves than I did, even though they'd never experienced anything quite as catastrophic as that day. But I realized that even in the midst of that, there were opportunities to make the money back during the day. That trading day, there's some wild swings when people dumped everything in the morning and then tried to pick the bottom and bought it back. So we had we had some wild swings in that day. And so I just watched, I watched what people did, and I tried to understand why, and I tried to replicate their behavior if I could figure out the triggers for it. And I've said this many, many times, but what that did for me was it made me realize that markets don't always go up, and that they can go down a long way in a hurry. Now, circuit breakers and stuff have ruled out the chance of that 25% drop in a day or 22% drop in a day happening again. But still, it's 2008, 2000, the Asian crisis in the late 90s. We've seen plenty of volatility in markets since. And I think, that's one of the big problems for people who've now built entire careers post 2008 is that they don't have this feeling, apart from the pandemic, when markets can go down and be really, really volatile. Volatility has been such a decreasing factor on markets that I think, the lessons that you learn in periods of adverse market conditions and heightened volatility are incredibly useful. So I was just delighted that with hindsight, at least not on the day, that I had that experience so early in my career.
I remember it vividly because, like you, I'd not long started, and it was quite shocking because I looked at this and I looked around. I assumed that this must have happened before, and you could see the
Right.
fear on everybody else's face. And of course, it was just after Big Bang, so we'd acquired a market maker. So we'd never had a book before.
Right.
So it'd been great, the 87 bull market. Thinking, oh, we're geniuses. We've got a market maker now, we're making loads of money. And I remember the head of the market making, the guy that owned the business and sold it to the company I worked for, he used to cover my stocks. And I remember being with him one day because I had results or something. And when you had results, the stocks went down. Oh,
Right.
I haven't sold that yet. It's that classic. It's a bear market, so when you have results, it doesn't matter how good they are, the stock goes down.
Yeah.
And they had this bright idea that they would turn the market round. So they got some horrendously large sum of money, which would be pitiful in today's money, but something like $10 million. And the market makers, they all coordinated that they would come in and buy the market and bid for stock at the same time. And they lit a whole panel of the FTSE 100 screen up blue. And of course, for about an hour or so, it turned the market because they thought, oh, there's some big institutional buyer come in and things are going to turn around, until eventually all caved in again. But no, it was a very, 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 very scary time. And although even then, I remember there were fantastic opportunities. I remember buying the Hanson convertible offering a 15% yield.
Yeah.
On the week of the crash. I mean, it's astonishing. So, you've lived everywhere, haven't you? You've lived in London, and then you moved to New York. Well, tell us a bit about living in different places, different financial centers, and how that colors your perspective in the world. Because you do have a different perspective if you're in Hong Kong, if you're in London, if you're in New York, because of the time zones. Well, how did you handle that, and what were your takeaways from that?
Well, I got offered the opportunity to go to Japan very young. I was 22, and excuse me, and just jumped at the chance. I mean, I had no idea what I was going to get paid. I didn't know where I was going to live. It just felt like an opportunity to me. So I said yes, and I even then I was young, but I figured, no, if it doesn't work out, I can just come home. If you want to work abroad, finding a job abroad is very difficult for visa reasons and all kinds of reasons. If you want to come home, it's easy. Buy a ticket, get on a plane, and leave everything behind you and be home. So it never felt daunting to me to go to Japan, even though back then it was a very foreign place. It was a very different world. I'd been a couple of times on business, and the first time I went there, I was probably, I don't know, 20 years old. I don't think I've been further than Spain. And here I am rocking up in Tokyo to this completely unfamiliar landscape. Everything was so different, but just wildly interesting. Just really, really interesting. And this was Japan at its peak, so everything was going gangbusters. So it was a very easy decision to go, and I'm so pleased I did because it lit a fire in me for traveling and other cultures and other countries. The job's very similar. Wherever you go, the job's the same. Buy low and sell high. If you want to distill it down to its basics, but the cultural differences are enormous, and the things that affect different markets that you got used to affecting in Japan that didn't affect them in Hong Kong. Certain headlines, certain behavior on the part of other markets. You just have to learn the same game with a whole set of slightly tweaked rules. But it was fantastic, and I've anybody that's ever come to me, even in those days, because I was so young when I went out there were a whole group of guys that came onto the desk behind me once I was older and had been to Japan and been to New York and stuff, who would come to me as a kind of peer of theirs. I was the youngest guy on the trading desk, so I was much more of a peer. And they would also say to me, I've been offered the chance to go to Frankfurt. I said, let me stop you there. Just go. Take the job and go. And if you hate it, come
Even
home.
Frankfurt.
Yeah, even Frankfurt, right? But you can come home. I said, if you don't like it, come home. And so that opportunity to go and live in all these places and immerse myself in these different cultures and different markets was just such a gift. And I've been grateful for it the entire time. And it's as much as you learn about the cultures, you learn about the markets and these kind of idiosyncrasies of the countries and the way that the financial systems in each one works. It's helped me build a group of friends, a network, if you want to use the kind of buzzword, around the world that I'm just truly grateful for. I've just met so many wonderful people, Steve, as you have, I know, just in different countries, whether they be locals or expats. And I've just found that in those environments, you're fortunate in the business that we're in that you tend to be thrown in the deep end with a bunch of super smart people, whether they're locals or expats. And the expats, because they've been interested in travel and been interested in living and working overseas, are normally interesting, thoughtful, curious people. And so, as I say, that's my greatest gift from all that has been the people I've met, without a shadow of a doubt.
And no favorite place?
No, I loved them all in different ways. I love Tokyo, and again, I think they talk about the past being a different country, and I was a very young man in Tokyo, so the experience I had in Tokyo has to be seen through the prism of a 22-year-old kid who's never really been anywhere. So I love Tokyo. I love New York. It was always a dream of mine to live and work in New York, and I loved that. I loved Hong Kong, Sydney, Singapore, all these places. I have enormous connections to all of them, perhaps with the exception of Singapore. And there's nothing against Singapore. Again, it was a particular time in my life. And while it was a fascinating place to live and work, I just never really developed an attachment to Singapore. I just found it was, someone asked me once, and I said, look, if you ask me to describe Singapore, the first word that comes to mind is nice. It's nice and it's clean and it's safe and it's all these things. And it's a wonderful place, right? It's a wonderful place. But there was nothing there that really got my heart racing. There was nothing to really love about Singapore and nothing to really hate about Singapore. Whereas if you asked me to tell you about Hong Kong or New York, for example, I could give you a list of 25 things on each side that got me so mad or I loved. And you need that. You need that kind of heart rate changing things to connect with. And I just never found that in Singapore. And again, I think that's because, when I was there, my kids were basically going off to college, so I didn't have the kids stuff to do. It was just me working, and I just enjoyed my time there. But it's the one place that I didn't really form, I don't think, a lasting, lifelong connection with.
Well, I hope you're enjoying this episode, and if so, you're bound to enjoy our free newsletter on Substack. It's a weekly email I send out each Sunday morning on interesting investing-related topics. Just visit behindthebalancesheet.com and hit that little sign up button on the top right. And while you're there, you should check out our fabulous online investor training school. Hundreds of students have taken our flagship Analyst Academy course, which teaches you everything you need to become a serious equity investor. And if you're a professional investor, We also run a forensic accounting course for institutional clients and a cohort-based course for smaller funds and for serious amateurs. Email me at info@behindthebalancesheet.com for more information. Interesting. I was expecting you to say that the world was very different depending on where you looked at it from. But I suppose back then it was less joined up. So when you were in Japan, Japan was an island on its own, and today it might be a bit different, because if you're in New York, you've got a very different perspective on what's happening in the world than if you're sitting in Hong Kong. You're a day difference, and I'd imagine that there would have been that difference. But listen, you've spent time in Japan, and Japan's very topical. So I had James Aitken on the podcast in December, and he's very interesting on Japan.
Mm-hmm.
And obviously, you're a real expert. And what James was saying was, watch Japan, because it looks likely that rates will go up, which means that there's a big opportunity for Japanese savers to repatriate funds. And if the yen's going up, it makes a hell of a lot of sense for them to do that. And then there's the issue, well, does that mean that Mrs. Watanabe is again going to be buying stocks? And she was a very, very influential investor globally in the past. What do you make of Japan today?
Well,
I know you've got investments there now, right?
yeah, it's fascinating. James is one of the most brilliant guys you'll find in this world. He's a genuine intellect and a super guy. He's become a very good friend of mine. And Japan's something we've talked about a lot. And it's funny, because I started my career there, I've just always had this soft spot for Japan, and I've always been willing to listen to the Japan is back stories.
But it happens all the time, though.
And this is my point, Steve. This is exactly my point. And I've had that kind of crushed out of me over the years by believing it one too many times. This is the year Japan's coming back, and I was so predisposed to believing it because I wanted it to be true. And of course, it's broken our hearts so many times. But interestingly, when I sit down to write things that make you go home every month, I never have a predisposed idea of. So I won't sit there in January and say, here's what I'm going to write about in February. I always want to sit down and write about whatever it is that I'm interested in when I come to sit down to write. And I may have an idea before that, but I don't start writing it until I get close enough that it's a week-long exercise, because something else might happen that's more interesting or whatever. So I always leave it. So consequently, I'm always writing about something that I'm genuinely fascinated by. And I've been very fortunate to kind of accidentally create this ability to write about anything I want. I'm not pigeonholed into stocks or bonds or countries or any of that stuff. And so I really have got this kind of landscape where I can literally write about anything. And what I found was, in the last year, almost kind of unconsciously, I'd written about Japan 3 times. So that's a quarter of my pieces was suddenly about Japan. And I only figured that out when I came to write about it for a 4th time back in, I think, December or November. And it's really interesting because over this last, I guess, 18 months, there have been some really strong signs that interest is flowing back to Japan. The thing that kind of got everybody's radar twitching was Warren Buffett buying stakes in the trading companies out there. And anyone that knew Japan back in the day knows how big those trading companies were back then, and what the kind of tendrils they have into every part of global business is fascinating. And just over this last 18 months, there's been more and more signs that Japan is kind of reawakening. It's been a story about the Bank of Japan. It's been a story about unconventional monetary policy, a dying bond market, a demographic cliff. It's been all these negative stories. And very, very quietly, what's been happening in the background is corporate Japan has been forced to really make some changes to get its house in order that it was just never under that pressure before. And so there's been this quiet revolution going on in the state of Japanese companies, in some of the rules around cross holdings, some of the rules, some of the behavior around dividends and buybacks, and all these kind of shareholder friendly things that have happened, which Japan was famous for not bothering with for many, many years. And the Nikkei and the topics have kind of come to life, and they've been making new highs. And suddenly, there are credible people like Buffett and like certain investors who have been talking positively about Japan. And when you've not looked at Japan for a long time, and you've believed it to be a dead story, as a lot of people have, because it has broken their hearts so many times over the years, and you listen to the demographic talk, and you think, well, what's the point looking at Japan? It's a dying nation. You suddenly get forced into looking at it again because, geez, everyone's talking about Japan. I wonder what are they talking about? This is nonsense. We've heard this story before. You take a look and you go, holy cow. Look where the indices are. Look at what's happened with the corporates. Look at the valuations of these companies. And this is still the third biggest economy in the world. I mean, it's the craziest unloved market on the planet to me. And so you have this great setup from a stock picker's point of view, where you can find really world-class companies trading on great valuations. But then there's this idea of getting comfortable with owning Japanese assets again. And a lot of that does come down to the Bank of Japan. And how are they going to screw me out of, am I going to make my money in yen? They're going to devalue the yen, and I'm going to end up losing money because of that. I find I can hedge the currency. There's things I can do. But am I just treading water, and the Bank of Japan is going to stop any real progress that I'm going to make? And this brings us to what James was talking about. And I think this is really, really important, because when James came and talked to Bill Fleckenstein and I on the podcast last year, kind of early last year, we talked about Japan a lot, because Japan has been this kind of focus of the end game that Bill and I have been trying to figure out. And James talked then, he said, look, Japan is going to normalize. They're going to move to normalized rates. And what does that mean, right? Japan's had negative rates for as long as many people have had careers. They know nothing of a Japan with positive interest rates, which is extraordinary. But there are so many similar type of statistics you can throw out that with the length of time that the current market current conditions have prevailed. Normalizing rates, if you've got a policy rate of minus 10 basis points and you take it to plus 10 basis points, it's a drop in the ocean. Right, it doesn't really do anything in terms of making borrowing less available to people. It doesn't really change anything material. But the message it sends, given where the things that respond to those sort of moves are trading, given where the Japanese government bonds are trading, given where the yen is trading, minus 10 plus 10 basis points makes no difference. But to signal that we are off negative rates and we are normalizing, we're going to move to positive interest rates, suddenly changes the mindset of a lot of people. And to your point about Mrs. Watanabe, and for those people not old enough to remember who Mrs. Watanabe is now, it's probably her great-granddaughter that we're talking about now, I would imagine, Steve. But Mrs. Watanabe was this kind of mythical person that represented the savings of Japanese, who are still the largest creditor nation on earth, external creditor nation on earth. And the idea was that all these Japanese savings would fly around the world and would drive asset prices higher. And it started out driving the Nikkei higher. All the Japanese money was going into the Nikkei. And then when Japan fell off its cliff at the end of 1989 and started going down and became this kind of investment wasteland for so many years, that cash had to go somewhere. So it went overseas and disrupted flows overseas. A lot of it went into the US stock market, European stock markets, elsewhere in Asia, overseas bond markets, because it couldn't really get a return in Japan. And so you send this message of the Bank of Japan, we're going off negative rate. Yes, it's a tiny increment, and we're not promising you that we're going to go to 3 or 4%. But our intention now, the direction of travel is we will use every opportunity we see to get rates up and normalize them. If we see an opportunity to raise 10 basis points, we're going to take it. That completely changes the mindset. And when you look at real rates and you look at exchange rate adjusted rates, you're getting very close now to the point where if you can get a 1% return on a JGB, a lot of the pension funds, when they set out their forecasted returns for the year, those negotiations come up in March. they're talking about 75 basis points as being the kind of pension fund money market account return. And so if you can get 1% on a JGB, a 10-year JGB, or shorter dated even, you're suddenly in this position where you can match your liabilities by buying JGBs. And so this question we've had of the Bank of Japan have hoovered up all this government debt. How do they get out of that? Suddenly, if capital flows reverse and Japanese money starts to come home because they can finally see a return to invest domestically, you've got this. It would be the immaculate landing. I don't expect it to happen, but the chance of there being an absolute meltdown because the Bank of Japan has to divest itself of all these bonds starts to become, excuse me, a little less problematic potentially, because if they can offload some of their holdings to pension funds, that helps. And the other factor that people perhaps aren't familiar with, because Japan hasn't been such a cultural focus of investment flows for such a long time, is the culture of Japan is such a cohesive one. And if the Bank of Japan or the Ministry of Finance get in the ears of the pension funds and say, okay, guys, we need you to bring money back home. We actually need you now to support your local market and, help us prop up the bond market and maybe funnel money into Japanese equities. They'll do it. They will absolutely do it just because the government have asked them to, which sounds crazy to us in the West. We can't conceive of such a thing, but it will absolutely happen. And so you've had this kind of weird situation where the yen was just getting pummeled and pummeled and pummeled and pummeled and going through all kinds of stops. And everybody was short the yen because, again, going back to this point of longevity, the yen's been a funding currency at zero for many people's entire careers. And so talk that the Bank of Japan is going to normalize, well, that doesn't matter. They can't do it. In fact, even if they do it and people are buying the yen ahead of that, what are they going to do? Get to plus 10 basis points? That doesn't make a difference. So you saw this crazy dichotomy where the Bank of Japan were making all kinds of noises about normalizing. You had a change in governor, which sort of said goodbye to the former governor, and brought in Ueda-san, which gave them a chance to change policy as and when. At least you got a new guy at the helm. And so the yen was getting pummeled, going through 150 like a hot knife through butter. And all the time, the signs were there saying this is an incredibly asymmetric trade, because if you get long the yen here, you've seen the Bank of Japan intervene a little bit at 150 and a little bit at 152.5-ish, just to say we're here and we're watching this. They didn't make a big deal out of it, but they definitely intervened. You could see it on the daily charts. If you went long at the yen at 150, your downside was pretty limited. It wasn't going to 200 with what was going on in the background. And here we are now. The yen jumped to 140-ish, and you can see a path to the mid 130s quite easily there. And there are all kinds of positive reasons to think that the yen could head back towards 100. I'm not saying it's going to go straight in a straight line, but the idea of being short the yen, I think, is just not a smart trade right now. And if you think how many people are short yen, which is basically everyone in the world with a carry trade on is essentially short yen, because that's been the funding currency, there's a potential for a massive short squeeze as well. So I just think it's a very long-winded answer. I'm sorry for that, but I just think Japan has become very slowly very interesting, and suddenly a lot of people are taking another look at it. And when you look at Japan today, if you haven't looked at it for 4 or 5 years, which a lot of people haven't, you will see something that is actually quite shocking to you in terms of how different it looks and the potential setup. So for me, Japan is one of the most fascinating countries that I'll be focusing on as we move through 2024 and 2025.
Because since that podcast, obviously it's coincidental, but since that podcast, yen's up 6%, and it's not exactly the sort of peak period for trading over Christmas. So, and if you were, if you can, well, you can probably put yourself in the position of a Japanese institutional investor better than I can, but I imagine that the conversations around the boardroom tables today will be, well, hang on a second, it looks like we'd be better off in yen assets than dollar assets. So why don't we, as we get redemptions, as the treasuries redeem, why don't we just switch that money back? And kind of, it's like, once people believe the bottom's in, and it will only go one way. So I wonder what if that's true, if that hypothesis is plays out, where should we be looking for the sort of the other side of the effect? Because it will end up. I mean, should we be worried about bonds? I mean, I was quite interested in you wrote a piece about the supply versus demand of bonds. We'll go on to bonds in a minute. But is treasuries where we should be worrying, or are there all sorts of other esoteric instruments that we can make good asymmetric bets on right now as the Japanese withdraw money?
Well, I think what's been interesting to me is when the Fed started to normalize rates, and we got into the beginning of this hiking cycle. I was thinking about this. We've been expecting it to happen for a long, long time, and everyone had said, me included, that they're never going to be able to get this up very far because the world has become much too dependent upon low interest rates to survive. They're never going to get the Fed funds rate to 2 or even 3% maybe before something breaks. And the more that Jay Powell signaled his intent to raise rates and tried to convince people that they were going to keep going and keep hiking, the more convinced I got. And as soon as you're convinced that we are moving into a higher rate environment after so many decades of lower rates, you realize very simplistically, and it's a very back of the napkin assessment, but if you think about it, it's not just a change in environment, it's a reversal of an environment. And so everything that works with lower rates and everything that's dependent upon lower rates, it's not that the world has changed, it's that they don't work anymore, right? Everything switches 180 degrees. And so if you think about that, if you think about what happens when you have a reversal in a market environment, it actually, what it does is, with broad strokes, it makes thinking these things through actually easier rather than harder, because it really is a case of what worked doesn't work anymore, because that worked because rates are lower. And I think people try and ascribe all kinds of reasons to outcomes in financial markets, but the cost of capital and the availability of that capital is by far the most important variable. So if you change the most important variable, i.e. you increase the price of capital and you restrict its supply, then it has a massive effect. And we've seen that. We've seen that through the last few years. We've seen it with the chaos that's been unleashed in the bond market. We've seen it in the equity market last year. And we've had this rally. Why? Because everyone's convinced the Fed are going to start cutting rates again. So coming back to the question about Japan, if Japan is suddenly investable again, if a country which has been a massive provider of capital to the world for almost 30 years now is suddenly a home for that capital, is suddenly going to attract, first of all, domestic capital back from overseas, and latterly, one would assume, foreign capital inflows, that capital has to come from somewhere. And so look at where Japanese money has gone. I mean, of course, it's gone into the treasury market. And we've seen Bank of Japan holdings in treasuries fall. They fluctuate, but they're always a big player in the treasury market. So whatever Mrs. Watanabe does with her overseas capital will have an effect on the treasury market. You can guarantee that. U.S. stock market, everything's gone to the U.S. stock market. Yes, there'll be pockets of Japanese capital dotted all around the world, but an enormous amount of it has gone into the US stock and bond markets, no doubt whatsoever. So at a time when the Treasury calendar of issuance is so remarkable in terms of its sheer scale, to have the potential for repatriation of capital from the biggest creditors of the world back home is another potential landmine that could lead again to forced rate rises, and certainly in the free markets, even if it's not at the Federal Reserve level. And again, this we get to this self-perpetuating cycle of rising rates again. And Japan has such a long way to go in terms of raising rates. If Japan got a little bit of inflation, as they've had the last year or so, they'd be over the moon because it does give them the ability to move. And I think, Stephen, you probably have watched this as closely as anyone, but the performance of Japanese bank shares, not the stock prices, but the businesses, just with this change in environment. If you look at what's happened, Japanese banks have got their balance sheets in order, their profits are coming through, they're doing really, really well in terms of executing on their businesses. And having bigger net interest margins, having the ability to use higher interest rates to juice those businesses, is a mouthwatering opportunity, perhaps, for Japanese investors to come back and invest in such a beaten down and now consolidated financial sector. I just think that wherever you look in Japan, you can finally make a strong case for why there's reason to be optimistic. And with Japan so unloved and the yen so out of favor and so weak, and sentiment about the Bank of Japan so low, and the prospects, everywhere you look, you talk about asymmetric bets. Being bullish on Japan, to me, is an asymmetric bet. And it won't be a straight line. There'll be bumps in the road. But if you want to think about a place to put capital for 10 years, I think Japan is starting to look incredibly attractive.
No, I totally agree. I just wondered where obviously Japanese are the biggest foreign owners of US Treasuries. So that's an obvious area of pressure. And that's an interesting area because I think in last month's new publication, you had that chart of the US debt maturity profile, and you wrote the cumulative deficit for the 2024 to 2033 period is projected to total 20.2 trillion. That's trillion, not billion, or 6.1% of GDP. Since 73, the annual deficit has averaged 3.6% of GDP. In CBO's projections, deficits equal or exceed 5.5% of GDP in every year from 24 to 2033. Since at least 1930, deficits have not remained that large for more than 5 years in a row. So, this whole issue about the bond market, I think is quite fascinating. I went to a conference in December, and there was a bond panel, and bond expert said, "Oh, don't worry. If there's a buyer's strike, governments have other tools at their disposal beyond QE, for they can sell shorter maturity bonds or reduce volume." This just sounds rubbish to me. Shorten the maturity. Well, you kick the can down the road for 6 months. Good luck with that. This is a structural issue at a time where you've got a huge lump in the maturity profile. 23, 24, 25. 25, not so much, maybe. Well, what's going to happen?
Well, look, we don't know. That's the beauty of this whole thing. But what I will say is that I think the key word here is structural. This is a structural problem, and you don't cure structural problems by selling shorter debt maturities. It just doesn't work that way. And there's a lot of people throwing stones at Janet Yellen for not extending the duration of the government portfolio, which I don't understand why she wasn't issuing more 20-year bonds, 30-year bonds. I don't get that. I really don't. But she didn't, and here we are. And the problem is, this is when the guy said, "Look, don't worry about that." You can kind of sit here and think, how can we not worry about arguably the single most important market on earth having numbers that would make your eyes water? And the simple truth, Steve, is you haven't had to worry about it. And so when people say don't worry about it, what they mean is, it's always gotten fixed before. So I totally understand why people say don't worry about it, right? And maybe we don't have to worry about it. Maybe we don't. But there are an awful lot of things coming together now that change things in another important way. And that is, we've lived through this period for at least a couple of decades, probably 3, of essentially coordinated central bank action. They all started off with rates in the kind of 6, 7, 8% level. Some of the Southern European countries, double digits that got brought back in '99 and brought back down to German interest rates essentially, which kicked off a lot of the stuff we saw happen in Europe in terms of crazy asset prices and crazy debt bubbles. But every central bank essentially was moving towards zero with their rates and issuing debt accordingly, and asset prices were going up. Everything was going in that one direction, and they were all kind of on that same train. Now things are very different, and now we're in a rising interest rate environment. Everybody, if the Fed lowered, everybody lowered because they could. And they knew that lower rates would be good for stock prices and bond prices and real estate prices. So if there was an opportunity to cut, they would take it. Now we're in a rising interest rate environment. And of course, again, things reverse. People will raise interest rates when they have to, not because someone else did. So people will hold back on raising rates for as long as they possibly can. And so you've now got to this point where it's competitive again, and interest rate differentials matter. And as rates move in one country, they don't automatically follow in others, and that has effects on the attractiveness of that country's bond market or that country's currency. And so we're starting to see swings and volatility come back into bond markets. There isn't a global bond market anymore. And that, I think, is arguably the US's big problem, is they have jacked rates up as high as they can, and they've done it quickly, and it has sucked in an awful lot of capital to the dollar and to the bond market. But now they have to issue even more at a time when rates are going up elsewhere now because people have been forced to do that. Capital is much more in demand now than it was because this abundant liquidity is no longer there anymore. And if capital is in demand, well, guess what? It looks for the place that's going to be taken care of the best. It looks for the highest bidder. So we're in a competitive environment. So the US has now got to fund its biggest deficits in history at a time where there's competition for capital. So it's impossible to say what happens or what time frame it plays out on. But what it is possible to say is that don't worry about it no longer works. Because whilst we might not know what happens or when it happens, you now have to pay attention. You have to watch Treasury auctions and look at the tail and look at what's happening. And we've seen some dreadful auctions in the past couple of months. And again, the headlines are terrible Treasury bond auction, and then the market kind of shakes it off. And people have become used to looking at markets and deciding that the markets have told them something matters or it doesn't, and that's just simply not true. There's a lag effect here. And I keep saying this, that, in this last 20 years, nothing's mattered to anybody until it's mattered to everybody. And that's been good when asset prices are rising. It's going to be terrible when things matter to everybody at the same time in a market that is looking to protect itself. So the Treasury market is, go ahead.
No, sorry, I was just going to say, why do you think people have been so positive? I mean, if we'd had this discussion a couple of years ago and we said, oh, they're going to put up rates to where they put them up, we'd have been assuming that the outcomes would be a lot worse than they actually have been. And I've been surprised that people have been so relaxed. I mean,
well, don't forget, for 20 years, right, people have been saying, first it was QE will lead to inflation. And of course it did, but not the inflation everybody was talking about. Everyone thought that the price of food was going to go up and heating and all this sort of stuff. And of course it was asset prices that went up because of how QE was implemented and where the money flowed to the holders of assets and the buyers of assets. So that whilst that's been disproven, QE leads to inflation, it was absolutely correct. It led to massive rampant asset price inflation. So people have become sanguine because they haven't had to do anything else, right? I was sanguine until the October 87 crash. I didn't think the market would go down 22% in a day. But I tell you what, the day after it happened, it completely changed what I thought was possible. But I needed that. If you'd have told me on October the 18th, 1987, the market could go down 22%, I told you were out of your mind. Of course it can't. Ridiculous. And it sometimes takes that kind of smack, and it takes a no-bid Treasury market for people to realize that the Treasury market can go no-bid. And we haven't seen that for a while. They've seen it in Japan. They've seen the Japanese 10-year government bond not trade for days on end. Who would have thought that was possible? If I'd have told you the 10-year JGB wouldn't trade at all on multiple trading days throughout the year, you'd have told me I was out of my mind before QE. And then when it happens and you go, well, that's obviously because the Bank of Japan's cornered the Treasury market and no one's going to take them on yet, makes perfect sense. But it had to happen before we could conceive of it. So I think a lot of things are going to happen that the past 20 years have disinclined us to believe could happen. And as and when they do, one by one, look at what happened with the collapse of Silicon Valley and Signature in March. We saw things in bond markets that completely shook people. You know, we had the CNBC bond markets in turmoil segments left and right. People didn't think that you could take $130 billion mark-to-market loss in your Treasury portfolio like Bank of America did. You can. You really can. And whilst they will do everything they can to bend the rules, and, you know, we're back to FASB 157 before the financial crash, right? When the people were going to have to mark stuff to market rather than not be forced to do that. And they repealed the rule because they realized that it would shatter all these illusions about what assets were worth. So they will, you know, when the stress becomes more evident, they will do things to try and stop it manifesting in markets. But ultimately, that pressure has to go somewhere.
Yeah, no, that's a very good point. So gold, you wrote recently, you cited Jack Ryan, the fictional character, which is a favorite of ours, Alan Greenspan, Kirill Sokolov, as fellow gold enthusiasts. And I was actually quite surprised to learn in that piece that gold had outperformed stock markets this century. But what do you think about gold? And I mean, I've been slightly surprised that it hasn't done better. I mean, obviously rates have gone up a lot, but presumably it should move now.
Well, look, gold's fascinating. Gold has been fascinating to me for 25 odd years.
What got you into it? What got you into gold?
I just, you know, reading in 2000 when the response to the .com bust was, you know, rate driven, you know, push rates to the floor. I remember reading the late Richard Russell, God rest his soul, who was a tremendous analyst who wrote something called Dow Theory Letters. And I used to read Richard voraciously, and he talked about what this meant in terms of what policy was going to be going forwards. And the policy going forwards was going to essentially be one of currency debasement. It was going to be policy-driven, rate policy-driven, lower for longer, and that was ultimately going to debase the currency. It just made sense to me. It just made sense that that was really the tools they had left. And it made sense to me that over time, they were going to reduce the purchasing power of the money, right? Because you have to inflate away this debt. The other options just aren't palatable. So, you know, I looked at gold then, and I'd never cared about gold before. I was aware of the gold price, and people used to talk about the gold price. You know, when I was young in the industry, I didn't know, oh, the gold price, right? I had no understanding of gold's connection at the center of the monetary universe, none at all. And I started reading about it in the late 90s, I guess, early 2000s. Early 2000s. And it just made sense to me. It just made sense to me. And I completely understand why it doesn't to an awful lot of people, because it's a pet rock, as people love to call it. But there was that longevity, and I love history, and the historical component to it made sense to me. So I remember buying my first gold coin. I wanted to understand, because one of the big kind of pushbacks against owning gold was, it's difficult, it's complicated to do, it's not like buying a stock, it's difficult. So I wanted to test that, and I'll never forget. I went and bought my first ounce of gold coin, and I paid $333 for it. And I handed over $333 in cash in return for a gold coin. And I'll never forget the feeling of handing over, you know, a bunch of paper and being given this little coin in your hand that is heavier than you think it is. So you kind of go, oh, there's something about that, a visceral experience of understanding what something's worth. Because both these things were technically worth the same, right? In one hand, I had these bits of paper that weighed nothing. They crumpled up in my back pocket, and find them in drawers, lying around the house, down the back of the couch, whatever. And you hand this over, and it doesn't feel like anything. And you get given something in return that's supposedly worth the same. But it's dense and it's heavy and it's shiny and it's beautiful and there's work gone into it, right? There's a coin, it's minted, and there's something about that, and it won't happen to everybody, but it connected me with what money and wealth, how different they feel. And so anyway, having done that and just noted in my head, wow, there's something about this that I don't understand. I don't get why I feel the way I do about this. I just went down the rabbit hole and started reading and trying to understand it. And my understanding as it developed, I went through all the conspiracy theories and down all the rabbit holes, and there's a million of them in the gold and silver markets. And they're fascinating stories and very interesting rabbit holes to go down, but they miss the point. And whether they're right or wrong is kind of irrelevant. So I did them, and I learned all about them, and I believe that they're not all false, but I've refused to get fixated on them all being true because that doesn't really matter in the scheme of things. But as my thinking evolved on it over the years, I came to think about gold unlike any other investment I'd ever made. And it was certainly not a trade to me. And I think this is where a lot of people kind of miss the point. Or not miss the point, but certainly think about it differently to what I do. If you want to trade something and you choose gold, it's a great thing to trade for a technician because it does swing around. It actually moves in both directions. It trends in both directions. It's volatile. The charts are always pretty accurate. It tends to react well to chart patterns. It's a good trading instrument. What I wanted it for was very different. I didn't want to trade it. I didn't want to buy gold and sell gold and try and make a profit out of it because you can do that with Apple shares and Google and Japanese government bonds, right? Instruments that don't have anything really to them anymore. I mean, yes, it used to be that you owned a stake in Apple, the company, but I don't think anyone that owns an Apple share really feels like a stakeholder in the company anymore. But for me, gold was a way to hold my liquidity reserve in an asset that would over time maintain its purchasing power. That was the important thing to me. As I say, when I understood that currency debasement was the way forward and inflating your way out of the debt, I realized that, if I save $10,000 and I stick it in a bank account yielding zero, in 10 years' time, I'll still have that $10,000, but it's going to buy me nowhere near what it bought me when I put it in. And over time, if you look at gold over the very long term, and don't forget, most people are not very long-term investors. We've become shorter and shorter in terms of our time horizons. Gold has performed that job very well. So I wanted to own it as a liquidity reserve and as a protector of my purchasing power. And it's done that and more since I started buying it in the early 2000s. As you say, since the turn of the century, it has outperformed equity markets, which is great, but it's not why I own it. And I never focus on the price. I never think about, oh yeah, we've broken 2,000, next stop 2,500. I own that gold as a way of holding my savings, and I only ever think in terms of exchanging that gold for something I want to own more. And my belief is, and I always use this, this example because it's such an easy one for people to get their heads around. But if 20 years ago I'd have had enough in gold to buy, not quite enough in gold to buy a harbourside property in Sydney, and that's what I really wanted, was to live by the water in Sydney. If my gold maintains its purchasing power along with the price of Sydney property, which it probably hasn't quite in terms of,
I very much doubt that, yeah.
But this is exactly the point, right? In the real world, absent these inflated asset prices, gold maintains its purchasing power. The inflated asset prices are absolutely dependent upon low interest rates and abundant liquidity for them to survive at those bubble levels. And the Australian government, if you pay attention to Australia, which I do very, very closely, the Australian government is doing everything in its power to keep the property market high because so much of Australia's wealth is tied up in that property market. And they're getting more and more desperate. But my point with the gold is, I own that gold. I'm not looking at the price. I don't want to sell it. But if there's a crash in property in Sydney, let's say the RBA is forced to put rates up, it bursts a property bubble, everyone's a seller, and harbourfront property in Sydney falls in half. I'm not expecting, but it's the metaphor that we're interested in here. Suddenly, my gold I can exchange it for that harbourfront house in Sydney. Same amount of gold, but at this exchange rate, if you like, I want to own the property more. So I will happily give up my gold. I'm not wedded to it, but I can exchange it, not sell it. I can exchange it for that house for an asset I want to hold more. And that's how I think about it. And I think gold does an incredible job of that. And as we go into 2024, that part aside, as I wrote in that piece back in December, and if any of your listeners would like a copy of that, I'm very happy to send it to them. I made the point that aside the purchasing power protection part of owning gold, the big picture, macro and geopolitical landscape is lining up in a very favorable way. Not that the gold price is going to want to go up, but the more people are going to want to own gold. It's really important to make that distinction because it's not about the price. There are more reasons for more people to want to own gold because more currencies are being debased, more bond markets are being debased, and more central banks are trying to own gold in the wake of the sanctions placed on the Russian central bank. So the price takes care of itself. If you have suddenly central banks for the last 2 years have bought more gold. In 2023, we haven't got the final numbers of 2023. In 2022, they bought more gold that year than they had since records began 70 odd years ago. They were on track, as I wrote that piece, to do the same again in 2023. And these are the most price insensitive buyers on the planet. They need to own gold. They have a whole load of paper currencies in their reserves, and they have realized we need to have more gold and less dollars because if we happen to upset the US, they could sanction us and likely the Russians and seize our assets. So we need to own gold. And not only are they price insensitive, but guess what? They can print the money to buy the gold. Isn't that great? If I could do that, it'd be fantastic. So you just have this incredible setup. And again, I want to choose my words very carefully. You have this incredible setup where more people are going to want and need to own gold. What that does to the price, I believe, will take care of itself because you cannot, unlike bonds and unlike currencies, you cannot just open the spigots up and print more gold. It has to be dug out of the ground. And again, I go into this in all the piece, how difficult it's gotten to get gold out of the ground. So there is a really constructive reason to be bullish gold as a trader, to want to own it as protection against currency debasement, and to benefit from increased demand against a backdrop of very fixed increase in supply. So I think 2024 is going to be a very good year for gold. And some people call me a gold bug. I very rarely come out and pound the table and say, I think now's the time to buy gold. I always want to own gold in different percentages of my portfolio as a liquidity reserve. But I think 2024 is going to be a year when an awful lot more people want to own gold.
That's very, very well explained. Although it's personally quite painful to me, the Harbourside, Sydney Harbourside property comparison is a very good one. It's painful to me because about 20 years ago, funnily enough, my then girlfriend and I were in Sydney and we thought, oh, maybe we should buy one of these. And oh man, I just thought the logistics, of owning a property on the other side of the world it just was too complicated. So I didn't bother. I always thought that, there are always opportunities in the stock market. This is a story of my life. My brother is very much richer than me because he's owned property, and borrowed. And I never liked gearing.
Right.
Now listen, you have the most amazing podcast. I don't think you disclose your subscriber numbers, but a paid podcast is incredible. You crossed 1 million downloads in 5 months. You may not know this, you were in the top 100 of all UK podcasts. Did you know that?
I did not know that. I didn't know that.
Which
no.
is that's quite astonishing for a paid only podcast, which is in the top 0.5% of podcasts globally. You've done, 130 odd episodes, which isn't actually long established. Barry Ritholtz, who was on the show a while back, he's coming up to number 500. But you've been incredibly successful. Why is that?
Christ, I wish I knew, mate. I honestly don't know, and I think that may be part of the the reason, to be honest, because I never set out to make a business out of it. I never set out to have a podcast. To be perfectly honest with you, I was bored in COVID and lockdown, just like everybody else was. And I'm sitting in the Cayman Islands, stuck on this island, unable to leave, unable to go out of my house, except for an hour a day for weeks on end, but curious about the world. This new world that we're in, what does it mean? What's happening? I don't understand it. And I know, going back to that network of people that I've built over the years all around the world, I know that there are plenty of smart people out there. And so I was talking to my friends, whether email or phone or whatever, just trying to kick ideas around and understand what was happening. And I was sitting there one day on Zoom talking to a friend of mine. I thought, it's so interesting what this guy had to say. I thought, other people would probably be interested in listening to this. So I set up a week of free public Zoom calls, and I had the letter that I've been writing for a long time. So I had an audience, but I put this thing out on social media, and I emailed my region and said, look, I'm gonna do a week of these. It's gonna be 3:00, I think it was, or 2:00 Eastern every day. It'll be a live 1-hour conversation, and just join in on Zoom if you want to watch it. And I did those. I called 5 friends up and said, hey, look, would you do it now with me? And of course, it was perfect because they were all locked down as well. So yeah, fine, great. So I did this week, and I really enjoyed them. We had loads of questions coming in and people live, and great feedback, and it was wonderful. And on the Friday, I finished up and said, look, it's been really interesting. Thanks very much, everybody, for watching. That was it. And I had no plans to do anything else. And the kind of weeks went by, and I got tons of emails from people saying, really enjoyed those. Are you going to do any more of those? Are you going to do any more of them? I'm still stuck in the Cayman Islands. So about 3 or 4 months later, I said, I'll do another week. Just get bored, and I'll do another week of it. So I called 5 more friends, and I set up another week of these things, and a couple of them were kind of panel discussions. And again, I just thought to myself, who are the people that I most want to talk to about this? I didn't think, who does the audience, who's a big name that the audience will come and through? It was like, who am I really interested in? Whose opinions do I want to hear? Whose thoughts do I want to hear? And I put that week together, and we sat down and we talked about all these different aspects of COVID and investing and how the world had changed. And end of the second week, I said, it's been great. Thanks very much, everybody. I'm off. And I got twice the number of emails coming back saying, are you going to do any more of those? And I thought, I'm not going to do any more of them. It just seems like, and the world was starting to open up a bit, and I was going to be able to travel again. And so someone said to me, I forget who, said, well, why don't you do a podcast? Why don't you do like a weekly podcast or something? I kind of thought about it. So it might be fun. I'm interested in talking to these people. So I looked into like the logistics of it all and thought, yeah, fine, I'll do it. So I started doing this podcast just for fun. And I would do, again, I never wanted to say I'm going to do one every Tuesday at 5:00. It was, if an interesting conversation comes up, I'll record it and I'll put it out there. So I did that, and it went out on iTunes, and it was, free. And I know it got into some charts because people used to send me this. I don't know how to look for an iTunes chart. I don't know how it works, but people send me, oh yeah, you're number X in this chart, which is great. And then I got more and more questions. Could you speak to this person? Could you do one with this person? And I found myself, I wasn't just getting people on that people said, could you interview them? I would say, oh, okay, let me look at that person. Oh yeah, that might be interesting. Or that person, it's not really what I'm interested in, but they were only conversations I was interested in. And this thing mushroomed, and it just became, it started taking up more and more of my time. And I loved it. I really, really enjoyed it. They were fascinating conversations. And I took something away from each of them. But it reached a point where I thought, look, I only have a finite amount of time in my hands, and I'm going to be traveling, and everyone tells me that this is an invaluable resource. So I thought, I'm just going to test the market. And if it's something people want to pay for, if it really is valuable to people, they'll pay a nominal fee for it. And if everyone says, which I fully expect them to, this is invaluable, it's going to be $10 a month. Yeah, I've got other things to do with my time, which I fully expected to happen. Make no bones about it. I thought, great. Well, it's not valuable to people. They've enjoyed it. I totally get why. But my time is incredibly valuable to me. It's the most valuable thing I have. And so I'm not doing this because I want to be an influencer or a personality. I'm doing it because I'm curious about the world. There are plenty of other ways for me to indulge that curiosity. So I said, this is what I'm going to do. And I had no idea if it was going to work or not. And it worked. It worked. It went, I put it behind a paywall, and enough people paid for it to make it stand on its own 2 feet. And it's kind of carried on from there. And I've, like I said, I still don't do a regular episode. I've got several different shows that I do with friends of mine as collaborators, all of them with a very different kind of theme. But we do them as and when there's something to talk about. I think I put 8 podcasts out in December because I had so many interesting opportunities to talk to people. And I just figured, look, I'm gonna have these conversations when they come up, and if the audience catch up on them in January, that's fine. But if I say to someone, actually, I've already got one this month, can you do it in January? And he goes, oh, I'm busy in January, let's do it in February. You miss a chance. So, I think I did 1 or 2 in November and 8 in December, and that's always the way it will be. I will never say there's going to be a podcast, because then you get to the point, God, I need someone to talk to for next Tuesday. Find me anybody, just because I've.
Well, that's why we're talking.
Listen, that's no surprise to me. If I'm here to fill a quota, I understand completely.
So has anybody refused? Has anybody refused to come on your show?
Has anybody refused? There's been a few people. I haven't had anybody, I don't think, outright refuse. I've had some people I've had to cajole. Famously, my dear friend and mentor Tony Deeden, who I spent 3 years playing Jedi mind tricks on to try and get him to sit down and do an interview with me, which he graciously accepted, thank God. And it's to this date still the single piece of video or audio content that I've created that I get the most emails about. Where are we? It'll be 6 years ago. 6 years ago next week we filmed that conversation.
Tony
Deeden, Deden. And there's a video. If you search my name and Tony's on YouTube, you'll find a video that we recorded during my Real Vision days. It's 2 hours and 25 minutes long, which seems incredibly daunting to a lot of people. And indeed, when I filmed it and I edited it down to 2 hours, 25 minutes, I got in a big fight with the guys at Real Vision saying, you can't put a 2 hour 25. All our content to that point had been an hour in length at maximum, most of it, 30 minutes long. And I said, this is just too good. I'm not going to chop another second out of this. I hated whittling it down to 2 hours and 25. This content is just too good. I refuse to do it. And I said, this is a hill I'm going to die. I will stand by this. And so I won that argument, and we put this piece out. And I was hiding behind the couch, Doctor Who style, terrified of what was going to happen when this piece came out. And I only cared that Tony was happy with it, because he'd done me a real favor by agreeing to do this. I mean, he didn't want to do it at all. So all I really cared about, I didn't want the comments to be 2025, a guy I've never heard of. Why would I watch that kind of thing? That was my fear. So we posted this thing at whatever midnight on a certain night it was, and I kind of wake up next morning and start looking at the comments, kind of like this, and actually got quite tearful, because the comments were extraordinary. They were, this is amazing. This is the most thought-provoking thing I've ever listened to. Why was it only 2 hours 25? And that conversation and the comments. It's up on YouTube, and YouTube is a place where, in any video, I think it's very difficult to find a video where if you scroll about an inch down the comments, and it's already turned into a cesspit, right? Of people, who's this guy? You don't know what you're talking about. No, you don't know what you're talking about. Why would it's just a cesspit. The video of Tony sharing his thoughts, just sharing his thoughts about the world. He's not making predictions. He's not giving you investment advice. He's sharing a philosophy and a way of looking at the world that is so profound. And you could scroll down those comments all day. And there are thousands of them. It's had, I think, 2 million views or something on YouTube now. You can scroll down those comments until you fall asleep, and you won't find a negative comment, which is extraordinary. And that's testament to Tony, purely and simply to Tony Deeden, his character, his integrity, and his view of the world, and how he manages to distill very complex world into a set of very simple principles and an awful lot of wisdom. And so, that's always been what I've been interested in, is having these conversations with people. So Tony took me 3 years to persuade him to sit in front of a camera and record that conversation with me. He hasn't done and he won't do any more media. He did one more podcast with me again when I launched the service, Tony kindly agreed to do a podcast with me. But I know, because he's a dear friend of mine, I know how he's returned down every single request very politely that he's ever had for a podcast. And he said to me, I won't do any more. I'm not interested in doing them. So I've had a few people that I've had to gently take my time and persuade to come and talk to me eventually. And there's a few of them that I haven't gotten to acquiesce quite yet. But if any of them are listening, I won't give up. I'm going to keep asking you very politely every now and again. Because I just think people have these experiences that are just too valuable to let die. Interestingly, Steve, I went to France. I had a few days off a couple of months ago, and I went to France. My father lives in France, and I went to France, and I took Franz, who's the guy that I work with when I film these videos, my cameraman, editor, director. He's a genius. I mean, the guy is just so good at what he does, and I love him like a brother. And I said to him, look, he was in Belgium at the time. He's from Belgium. I said, can I borrow you for 4 days? And I flew him to France, and we went to see my father. And I sat down with my father, and I recorded a 3.5-hour interview with my father, just about his life. Not for anybody else, but for me and my brother and my kids and my grandkids. Because my grandfather, my father's father, died before I was born. I never knew him. And my grandfather, who I adored when I was a kid, I didn't know his story. I didn't know his life. And so I wanted to get this story of my father's down for generations. I mean, maybe they're not interested. I don't know. But at least if they are, they can hear about what life was like in the war in Great Britain. My dad's 85 this year, so he was born right at the start of World War II and was evacuated and spent the whole war up in Burnley, of all places. But just hearing what the world was like in the 40s, 50s, 60s, 70s, and through, was fascinating. And I think this idea of telling stories, everyone's so fixated on investment advice and actionable ideas. The word actionable makes the hair from the back of my neck stick up, because everything's actionable, right? What people mean by actionable ideas is spoon-fed ideas. Every single thing is actionable. Everything you've heard us talk about in this conversation today is actionable if you sit down and take the time to think about what's been said and how it applies to your own life. And so I'm not interested in stock tips. I'm not interested in you and I talking about, hey, what should we buy today? Because today is whatever day it is, January the 5th, I think, Thursday, January the 5th. Depending on your editing schedule, this might get released on Monday, let's say, Monday the 9th of Jan, I don't know, Monday the 8th of Jan, sorry.
I can tell you, because we publish on the third Thursday of the month.
Okay.
So right. I do a monthly schedule, and so whatever the third.
Yeah.
Thursday,
so this will go out on the what are we talking? 19th, probably 18th, 19th.
18th of January. Yeah.
Fine. So it's 13 days from now. If you and I were talking about stock recommendations, anything could have happened. The company could have gone bust. The company could have doubled, and people will listen to this and take that as a moment in time. Oh, so and so said to buy this company. They look at the price. They buy the company. What do I do now? And there's just, you might get rich. You might lose all your money. And if you get rich, you're going to think you're a genius. And if you lose all your money, you're going to want to blame the guy on the podcast who told you to buy it, right? It's human nature. That's not a detriment to anybody. It's how we all function. So I have such a strong belief that talking about experiences and philosophies and how you see the world and why you see the world that way rather than what you see is timeless and provides people with a window into people's mindset and people's careers that is valuable over time. And so, that's really what I love to do is sit down with people and talk about their careers and find the points in those careers where they've encountered either triumph or disaster and pick apart, okay, what happened? Why did you react the way you did? What did you decide to do? Why did you decide to treat it that way? Because that way people can apply those lessons to their own life and they're absolutely actionable.
No, I completely share that sentiment. I totally agree. And what a wonderful thing to do, to film with your dad.
God, I'm so lucky. I'm so lucky. And Franz is, Franz is a genius, and my dad's a lovely old duffer.
What did your dad do?
My dad, he did a bunch of things. He was in the army after World War II for a little while, conscription. He was in Germany driving a scout car, and he uh, he worked for a bunch of industrial companies. Ended up being the company secretary for a merchant bank, and then he set up a recruitment firm, a financial recruitment firm. So he's
Oh,
done a
really?
bunch of different things, and as a kid, your parents, they're around you, and you kind of know what your dad does a bit, but what do you really know about their lives, and what do you really know about um, what they've been through, and I think for everybody, you don't have to take a bald Belgian Vin Diesel lookalike cameraman with you to do this. Get your iPhone out and sit down and ask your parents to tell us. Just tell me a story. Tell me about your life. And you don't. People think, oh, right, I need to have all this list of questions. You don't. It's a conversation. Ask a question. Tell me about when you were born, and whatever occurs to you to ask them when they say something that you're curious about, follow that rabbit hole. Ask them the question. And it's amazing. You look around what's happening, and I think I said this to my dad when we were having this conversation. I said, my dad, my dad's an old man now, right? He's 85. He's in incredibly good health, and his disposition is extraordinary. He's just a wonderful, wonderful human being. And I love him to death. But he's an old man. He turned 85 a couple of days ago, and when I watched footage on CNN or whatever it was a few weeks back, a couple of months back maybe, of people smashing windows of Jewish cafes in Paris in the middle of the day, I was horrified. And I'm thinking, how can we possibly be here again? How can we be here again? That this is okay. It just makes no sense to me. And that was when I thought about this thing with my dad, because I realized at the time my dad's 85 and he was born in 1939. He was born at the outbreak of World War II. So he doesn't remember World War II. He was whatever, 5 years old, 6 years old when war ended, and he came back down to basically meet his parents for the first time. So he doesn't remember the war. He doesn't remember the 30s and the rise of kind of fascism in Germany and the rise of Hitler. He doesn't remember them. So the stories of what happened are gone. And when we lose those stories, and when we don't teach history anymore, and we don't teach those stories to people, of course we forget them. Of course, the kids out there smashing up windows because it seems like the cool, woke, trendy thing to do, if they understood what happened in 1930s in Germany, there's no way they would do that. But they don't. And so I think these stories that we have to kind of perpetuate are important. And they're important to get them down. They're important to preserve them. They're important to pass them on. Because, everything is cyclical. And my friend Neil Howe wrote this tremendous book, The Fourth Turning. If nobody's read it, I cannot recommend this book strongly enough. It was written in 1997, published in 97 by Neil and his partner, the late Bill Strauss. And it was a look at the generational cycles of humanity. And when you read that book, and in 1997, they basically said, to paraphrasing slightly, but they said, that the fourth turning, which is a time of crisis and happens every 80 years, will begin roughly in 2008. It'll probably begin with a financial crisis, and it will culminate in some kind of conflict, a war of some sort. And so, these cycles repeat, and it's only by preserving the stories, it's only by people understanding the actions and the intents of the people that went before that we can avoid making the same mistakes again. And I don't expect us to do it, but to sit idly by and say, well, it's not even worth capturing these stories because it's not going to make any difference, just doesn't seem like the right thing to do to me.
No, absolutely not. Before you go, I just wanted to talk a little bit about the newsletter, because I was curious. You started that some years ago when you were still working at a hedge fund.
I
And
did. Yeah, I did.
what made you do that? It seems like, working at a hedge fund is quite stressful. I mean, the last thing when I was working at the hedge funds, I barely read any books. I mean, it was just like an all-consuming affair. I had no bandwidth for anything.
Yeah. No, I actually, I wrote it while I was at a hedge fund. I didn't start it at a hedge fund. I started it when I was working for a company called BTIG, which is a US broker. I was working for them in Singapore.
Oh, yeah.
And it was much shorter. The format's changed over the years. It's become much more involved and detailed. But it was basically a daily collection of stories that were flying under the radar that you wouldn't, if you were just relying on CNBC and the BBC and CNN to get your news, you wouldn't have seen these stories. And this was kind of the early days of the internet and Zero Hedge and all these kind of gonzo finance sites that were publishing some really interesting stuff actually at the time. And I would go through all this stuff very, very early in the morning, 3, 4 in the morning. I'd be sifting through, trying to find interesting stories that I thought, oh, that's interesting. That might mean something. Hence the title, things that make you go home, because all these articles that I would send people were things that I thought two things. One, that they'd be curious and interested in them. And secondly, they would be able to use those stories and the information contained in them to sound smarter to their bosses. Like, oh, did you know this is going on in, wherever, Ulaanbaatar? Because I knew that if I could provide people with something that was interesting, but also they could use that information however they wanted to use it, it would be valuable to them in terms of the time spent reading it. And that was really my only desire. I don't want to be a waste of anybody's time. So that's how it started. And I left that job and on my last day, I was taking a month off before I joined another firm. On my last day, I wrote to everybody on the list, and it had grown organically. There was, I don't know, maybe 500 or 600 people on the list at that point.
Oh, really?
And it literally started off with like 10 mates. And I wrote to them. I said, look, this has been great fun. I'm leaving. I'm joining such a firm in a month. Here's my personal email. Stay in touch. It's been a great ride. Thanks for all your business and all the conversations, etc. Whatever. And I went to the pub with my mates. Our mutual friend, Steve Conway, I think, was among them. And when I got home later that evening, I had all these emails from people saying, first of all, congratulations on the job and good luck, blah, blah, blah. But they all said, if you resurrect this mailing list at your new place, can you please make sure you include me on it? Which I thought was really interesting. And so I had this month off. I wasn't going anywhere. I had my daughter with me. She was at school, so I wasn't taken off for a month or anything. And so I just kept doing it every day because I wanted to stay current on what was going on. It took me a few hours in the morning, but it was, 3 till 6 in the morning when no one was awake anyway. So I just kept doing it for myself, just to stay current and to stay engaged. And then, from there, I took it to my next firm with me, and I said to them, look, I do this thing. I'm happy if you want me to do it to send to our clients, or if you don't want me to do it, I don't mind. It's either way, but it's there if you want to use it. And they did, and then I got fired over it, which is a whole other story for another day. And went back so I stopped publishing it because I got fired over it, and then I was out of work for a number of months trying to fight a big lawsuit against this company. And I thought, screw it, why am I not doing this? I enjoy it. I'll just start doing it again. So I started doing it again just for fun and doing it once a week. And I would send it out on a Saturday. And John Malden found it and picked it up and contacted me and said, hey, look, I'd love to distribute this to my readers. It's such an interesting piece. And that was it. That was the makings of a letter and the makings of a business. I owe John so much for his kindness in distributing that, and he's become a dear friend over the years. And it just accidentally became a business thing. I didn't set out to do it for any reason other than I found it interesting, and I think that's the best way to do anything. If you're interested in something, it just never feels like work.
No, absolutely. I completely echo that. In my new role, the stuff that I'm doing is enjoyable.
Yeah, it makes a difference, right?
So I'm conscious of your time. I normally ask people to recommend a book. Do you feel like recommending a book?
I can recommend you tons of books. I read a lot of books. But the only problem I have is recommending one book. That's the only problem I have.
You can recommend more than one.
There's a couple of books that I always recommend because I just think they're that good. One is The Lords of Finance by Liaquat Ahmed, which is a great account of the central bankers of the 1930s and all the conditions. And the more we go through this fourth turning, the more that book becomes a useful handbook for the times we're in and a useful way to understand the forces pulling at central bankers. So I would absolutely urge people to read that book.
Yeah, it's a great book, yeah.
Another book that I love to recommend is a book called A Gentleman in Moscow by a guy called Amor Towles, Towles. It's a fictional novel, but it's set in and after the Russian Revolution about a count who was imprisoned in a hotel in Moscow, and it's just a beautifully written story. It's the first book in many years since I was a kid that I finished. I turned the last page. It wasn't a disappointment, which is you get that fear as you approach the end of a great book. So please stick the landing. And he did, and I turned straight back to the first page and started reading it again. It's such a wonderful story. I would again urge people to read The Fourth Turning by Neil Howe and William Strauss. And Neil last year, or earlier this year, last year, I can say that now, published the sequel, The Fourth Turning is Here. And I think those two books are incredibly important for people to read and understand. And then I'll give you two more. The Guns of August by Barbara Tuchman, which is the build-up to World War One, which is just an incredible historical document. And the book I read recently for fun, which I don't get much time to do these days, but I recently read Alan Shipnuck's Live and Let Die, about the Live Golf Tour and the PGA Tour, which I found really enjoyable. If you like golf, it's a really good read. It's just a fun read. It's a very easy read, and I loved it. How's that? There's a few there for you of all different types.
Oh, brilliant. Well, I'll link to them in the show notes. I didn't want to touch on sports because I believe you are a Manchester United.
No. I'm a Fulham fan. I'm a Fulham fan.
You're a Fulham fan. Well,
I'm a Fulham fan.
Allegiance.
No, God, no. Do you know what? I took my dad to Craven Cottage last year, and we were sitting at half time of the Brighton game. We realised that it was his 75th year of going to that same stadium to watch football matches, and my 50th.
No.
Yeah.
Wow.
Yeah. So no, I'm a Fulham fan, lifelong Fulham fan, and there is nothing in this world that would either change my allegiance and nothing I love more than going to Craven Cottage and watching them play.
All right. Well, you need to let us know when you're next going. My elder boys are sadly a Manchester United fan, but Fulham is the closest ground where you can watch some decent football from us. No? Tell people where they can find you.
In person, very difficult. I'm always moving around the place, but on the internet, you'll find everything you need to know at grant-williams.com. And my Twitter account, if you're interested in that, which less and less people are on that platform these days, you'll find me at TTMYGH, which is just the acronym for things that make you go hmmm.
Grant, it's been a delight, a pleasure to talk to you. I didn't open with this, but I don't know if you're aware. I mean, I have read, I don't know how many thousands of pieces of research in my life. And the one piece of research that I have picked up, read, and it has made me money. And I'm sure there have been pieces of research that have made me money laterally, but very few pieces of research saying buy X, Y, Z have I ever paid any attention to, probably to my detriment. But you wrote about a vote that was taking place in one of the Swiss cantons as to whether the Swiss central bank reserves should be backed by gold. And I thought, oh, crikey, if that goes the right way, the Swiss franc is going to be forced up. And if you remember at the time, the Swissy was pegged to the euro. And I thought, that's really stupid because Swiss franc's worth more than what I can buy it at. It's a no-risk trade. And there were a lot of people shorting the Swiss franc. And of course, it was kind of the inverse of the Bank of England. And sadly, I didn't have as much money as George Soros, but I put what was then, a serious 6-figure sum into the Swiss franc. And 2 months later, I came in one morning and the guy opposite me was pale. And he said, you never guess what's happened. What's happened? The Swiss franc. And I phoned up, I picked up the phone to my bank and I said, sell 100 grand of the Swissy. And the guy looked at me. The rest of the day was more complicated as I tried to extricate my clients from various Nestle and Roche holdings. And that was a bit of but so I thank you for doing this. And
that was a while ago. That was a while ago.
A brilliant newsletter and having a really amazing podcast. hopefully we shall see each other next time you're in England.
For sure we will, mate. For sure we will. We'll catch up in person, have a nice dinner. That'd be great fun. I'd love to see you again.
And thanks again.
Mate, anytime. Always a pleasure, Stephen. I'll talk to you soon. Take care.
Well, I hope you enjoyed that as much as I did. Grant and I were introduced by my good friend Jonathan Tepper, and Grant then arranged for me to be interviewed in Real Vision, and that led to my doing several shows for them. Grant had me on his podcast, and that immediately generated significant business for my online school. He even let me contribute to his newsletter, Things That Make You Go Hmmm, last year. So apart from my gains in the Swiss franc, I have a lot to thank him for, particularly for doing this podcast. And the takeaways for me were 1, watch Japan, 2, watch Treasuries carefully, and 3, keep on top of what's happening through Grant's work. You won't often hear me recommending a podcast, but $10 a month is stupidly good value for Grant's content. If you enjoyed this episode, please tell your friends, share it on social media, and please leave a review or even just a 5-star rating on Apple Podcasts or Spotify. It really helps. Thanks for listening. Thank you for listening. I'm Steve Clapham. That was the Behind the Balance Sheet podcast. Please don't forget to subscribe to the YouTube channel. And why not visit our website, behindthebalancesheet.com, where you can find the show notes and lots of other videos which can help you on your investing journey. Thank you for watching.